Hey, I wanted to welcome you to this short video about RoBS, which is the Rollover on Business Startup. This is a very interesting topic and transactional process that entrepreneurs and business owners can embark on. Essentially, as a summary, we can access 100% tax and penalty free our qualified funds, IRAs, 401ks, SEPs, 403bs, key-off plans, all kinds of different plans will qualify for this type of transaction. So let's get jumping into it. The examples that I'll be using throughout the presentation deal primarily with real estate investors. So you can use the same strategy. Everything is pretty much the same as far as the uses of the funds through any other kind of business. Even if you've been in business for quite a while, we can still access these for your business. Hello, my name is Joe Nielsen. I'm President and CEO of Clear Capital Group. What we do is a consultation and brokerage firm in the commercial real estate and business industries. Personally, I've been an investor since 2007 in real estate, primarily single-family homes, in 5 different states across the United States and some international stuff. Since I've been in high school, quite a while ago, financial education has been a hobby and a very high priority for me. And I also really enjoy medical and science. So I have a degree in medical laboratory science that I got at a traditional university. So my personal mission statement and Clear Capital Group as a whole is what we try and do is identify your options for funding. Based on those options and your goals, we determine a strategy, and then we achieve your goals through those various options and strategies that we've identified. So the RoBS transaction, the Rollover on Business Startup, is very creative. It's fast. It takes typically 4 to 5 weeks to get the funds into your business bank account so that you can start using them. This is an entirely debt-free option to fund your business or start your business. And it's very minimal work for you because a lot of the heavy lifting is done by the attorneys and CPAs that we have working behind the scenes to craft and make sure everything is compliant and operational for you. And this speaks to them a little bit as we have a very experienced and knowledgeable teams that we work with. They have many years of doing this. No IRS audits there on the 4th bullet down is very important. There are many other firms out there, companies out there that say that they'll do this for you. Oftentimes they'll set it up for you and then they'll say good luck, go out and use it yourself, and then they won't follow up with you and make sure that you're compliant from quarter to quarter on your taxes, payroll, and all that kind of stuff. And so oftentimes they will incur IRS audits simply because they are not helping you every step of the way. So we work only with teams that help you every step of the way, make sure that you are compliant, doing things by the book, which is the only way to do business anyway. So all administration and things are done in-house with these partners. And our approach is we consult. We do not sell. We don't have to sell money. We handhold every client through each step. This is your hard-earned money in qualified funds, and we want to make sure that you're educated and you know exactly what you're getting into. So we keep our client partners well informed. We encourage communication with clients, financial representatives, your CPAs, etc. In fact, we'll have consultation calls and strategy sessions and things with your CPA of choice, whoever it is that you trust with your bookkeeping or your taxes and things. We want to make sure that they're up to date on the policies and procedures on how to administer this appropriately. Typically, coming from, like I said earlier, from a real estate investing background, there's been a lot over the past 20 years, I'd say, a tremendous amount of third-party custodians, companies popping up all over the country to help investors and business owners use their self-directed IRA funds. And the reason is because there's many trillions of dollars locked away in qualified funds, And a lot of people are disillusioned, or they're simply sick and tired of the risk and volatility of stock market. And so what they want to do is they'd rather have control of their funds instead of putting them into the stock market. So they choose a self-directed approach, which allows them to direct those funds into an asset that they know, and primarily real estate, for example, so that they can generate a steady return, something that's more predictable, something that's more familiar to them, that isn't so exposed to wide swings in the paper asset community like stocks and bonds and mutual funds and things like that. So on the pros, it allows you to choose your own investment. You can buy investment real estate. You can increase your rate of return. You have control, some semblance of control. You can capture all those returns back into your IRA account to defer taxes. And typically you don't have to have a legal entity to use these self-directed funds. Although it is wise to have one for litigation purposes. On the cons, you're limited on what you actually can invest in. There's a lot of rules and regulations that say you can or can't invest in this type of asset or not. Limited on how you can use the funds. So again, you're very limited on the use. And if you use these for personal gains, or if you manage the properties or the assets yourself, oftentimes there's going to be some taxes and penalties that are assessed. You cannot go out and obtain financing typically with a self-directed IRA. You can't use the money for a leveraged position, for example, put 20% down and then finance the rest of a property acquisition, or use it to go get an SBA loan for your small business and use it for an equity injection for the SBA program. All of that is typically not acceptable with a self-directed IRA or 401k. There are some minor exceptions with non-recourse 50% LTV loans on real estate, for example. You cannot buy life insurance to implement an infinite banking concept. So if you're familiar with the bank on yourself or the infinite banking concept, using your self-directed IRA funds or 401k funds, it is prohibited to buy life insurance, so you can't do that. So there's a lot of pros, there's a lot of cons, and again, it's basically identifying options, determining strategy, and then choosing which one's going to get you to that goal. So on the 401k rollover, or the RoBS, Rollover On Business Start-Up, you can use these funds for any business expense. It doesn't matter what your business is. You can use these funds for. So you can start a new business, capitalize it up front with no debt because you're using your own funds. You can use it for working capital, expansion. You need to go acquire some more leasing space for operating your business. Payroll and salary, you need to hire some more folks. Or you want to pay yourself a salary, absolutely fine. Get a loan or a mortgage, you can do that. You can go out and get a leveraged position through this kind of transaction. So there's no restrictions on that. You can go get multiple properties with your $100,000, and we'll have an example of that later on. You can buy life insurance. You can implement your infinite banking concept and incur a tax write-off because it will be a business expense at the same time. So that's pretty cool. You can grow your real estate investment portfolio. You can use this for marketing expenses. Again, for any business expense. And here's how it generally works, is how we set it up. So starting on the top left, we're going to move and follow the arrows. So let's say you have an old IRA or 401k plan that is not with a current employer. So let's say you have changed jobs in the last 8 years, but you've been in the job market for 20 years, 30 years, whatever the case may be, and you have several 401k plans hanging out in limbo, just doing nothing. And what we can do is we can take those IRA funds and we can roll them over into a newly created, here's the triangle, 401k. It's typically going to be a profit sharing plan. And this new profit sharing plan will actually purchase or invest in shares of a newly formed privately held corporation. Now, that newly held privately that newly formed and privately held corporation is yours. You own it, you control it. So what happens is you as the client down here in the circle, your new entity will offer up stocks or that paper asset, and your new 401k will purchase those stocks. And so as you can watch the arrows here, the money that was transferred from your old 401k, which is now in your new one, purchases the stocks that the entity has just offered up. Those stocks or shares transfer to the ownership of the new 401k, and the money transfers to the business entity. Now this business entity is fully funded. It has working capital now in its bank account that it can direct however that business sees fit. And in this scenario, we're going to use it as a real estate investing scenario. So now the money is going to flow from the entity, flow into the client's LLC that they hold for the real estate, and they're going to buy more. They're going to grow their portfolio. They're going to buy some more. Maybe it's a fix and flip business. Maybe it's a buy and hold. Maybe it's a syndication to purchase large commercial properties, whatever it may be. And then the IBC policy right there is the infinite banking concept policy, which is very popular with real estate investors and is gaining in popularity with small business people. The newly formed corporation now directs the capital into business expenses, so requiring marketing, advertising, payroll, whatever it is that you can think of. So that's generally how it works. And if you need to, go back and review this, but we'll touch on it one more time in a very drilled down step by step. And here we go. Roll over your old funds. You can roll over all of it or just a portion of it. So let's say you have $100,000. You want to leave some of that in your old 401k plan. That's absolutely fine. Roll over the rest and use that money for your new startup and venture. So what you do is you just contact your old retirement administrator where those funds are currently being looked after. Designate a new place for those funds, and that's going to be the new profit-sharing 401k that we'll set up. You initiate the funds transfer once the new plan has been established. No expenses to do that. It's just a straight roll over. None of the money comes out of any qualified account, and it never touches your hands. And so there are no taxes and penalties or distributions or early withdrawal penalties ever assessed during this process. Here's your new 401k plan that was created by one of 3 of our partners that we work with. They create the 401k for you. Your old retirement funds are rolled into the new account, and now you have control of that 401k funds. Why? Because you own the plan indirectly through the corporation that owns it. So here's the corporation. So what we do is we set up a new corporation for you. We help you incorporate in preparation for your new business and self-directed 401k account. Again, like we talked about in the larger overall perspective on the other slide, your entity or your business will offer up shares or stock shares for purchase that your retirement account will purchase. These funds are now in the business bank account and can be used for any business purpose. Important things to remember is that this is not a distribution. You're not actually paying the profits or accessing this capital into an outside entity. From the IRS standpoint, all of this is still contained and being operated within a legal qualified plan. So no taxes and penalties. It is investing in your own business. Hence, you can write off legit business expenses by using your 401k or qualified funds to fund your business, which you oftentimes can't do that with, well, not oftentimes, you can't do that with your other options. This is penalty free. Again, no distributions, no early withdrawals. You are using this in an IRS compliant way. So you're completely protected. It's fast funding, like we talked about earlier, typically 4 to 5 weeks. What is required to get started? So you must have qualified monies, and qualified money simply means that it is qualified by the IRS or designated by the IRS to be tax favored in some form or another. However, these are standard and traditional IRAs and 401ks, not Roth IRAs, 401ks, or inherited IRAs. So those are the three exceptions. Your 401k, 403bs, Key-Off, TSP, SAP, all of these other types of plans can be accessible through this RoBS transaction. So it must be from a prior employer, like we said. It can't be currently with your current employer. And then you should have a minimum of roughly $45,000 to $50,000 in one or more accounts that you'd like to roll over. We keep that at a minimum. There's no max on how high you can roll over, but there is that minimum of $45,000 to $50,000. So I like to explain to clients and to you that this really is not a foreign topic to you. You actually know very intimately how this works. And it works just like this. Here's Walmart, New York Stock Exchange, and what do? Every single day on the stock exchange, they have shares or stocks available for purchase, right? And people are buying stocks and bonds and mutual funds all the time at rapid speed on the stock exchange with qualified IRS monies, 401ks, 403bs, IRAs. It's just you are usually, or the individual who owns the stock money, the qualified funds is usually removed. This process is typically taking place behind the scenes by a financial planner or the financial administrator of the plans for the company who you work for, etc. But the process is exactly the same. So what happens is you purchase shares in Walmart the same way that we're going to have you purchase shares in your own private company. Same exact scenario. So Walmart offers up shares. You say, I want to buy that. The asset, the paper asset, Walmart share changes ownership to you into your 401k. The money transfers ownership to Walmart now in their bank account that they can go use it and build another store, buy inventory, pay payroll, whatever it is that they need that money for. And it's all a legal, legitimate, and very compliant process. And so people do this every day with their financial advisors on the stock market like we just talked about. And so you can buy shares of Apple, Walmart, any other kind of publicly traded company. What we are going to do is the exact same scenario. It's just we're going to take it from the public space and bring it down to a private space where you are both the investor and the business. And this is completely legal and ethical. Important things to remember is that this process comes with tax breaks. Why? Well, because number one, you're using it for business purposes. And if you have a business, just like Walmart has a business expense, they can write that off in their taxes. You can do the exact same thing. And in a 401k profit sharing plan that we'll set up, you can defer up to $56,500 annually pre-tax. So if you also wanted to use the 401k money to fund your business, generate good profits and revenue with that business operation, you can then bring that money back into the 401k up to that amount per year and defer those taxes. So you can use it in multiple capacities. Just because you bring the money out of that 401k to fund your business doesn't mean that that 401k is now gone or non-accessible. You can still use its tax advantage status moving forward, which is great. Some people choose to use it to its full advantage and other people choose not to. It's completely up to you. So we help clients cover exit options as well. So clients always have the option to buy their stock back and make a clean exit. So for example, let's say you have rolled over $50,000. You've bought stock in your business. That business now goes and does its operations and things like that. But there's still a connection between the 401k and your business, right? If you wanted to separate that connection and then dissolve that scenario, essentially what would happen is the business would have to use revenue that it created to purchase the stock from the 401k now, and then those two entities can be separated. So you can do that if down in the future you want to make a separation. That's completely fine. Remember that this option can be combined with a loan or a mortgage. You can use it to leverage. So the funds are 100% liquid and can be used for your money down for or equity in a new loan. So, and we like to talk about this with real estate, and we'll come up shortly with we like to talk about this with real estate investors in particular, and we'll show an example here in the next couple slides. So moving out of the self-directed IRA and into this strategy, you are going to be able to leverage your dollars into multiple assets instead of being tied to just a single asset. And we'll see the benefits here in a numerical sense in the next couple slides. So, or you can use these funds in a variety of scenarios to best accomplish your personal and business goals. Remember, it's in a business entity, hence it can be used for business purposes. So here's an example that a real estate investor would be very familiar with. So on the top, we're going to have $100,000 in a self-directed IRA. That money goes into purchasing a house. Now again, you have a third-party custodian that approves this transaction, and they make that transaction for you. Let's say this $100,000 house that you have free and clear now, that you bought with cash, is producing a gross rent of $800 per month. That equals to $9,600 per year, which is a 9.6% return. And all that money that the rent or the asset generates will be funneled right back into the IRA, and you'll be enjoying that 9.6% return per year, which is great. You know, you're probably not getting that on a consistent basis in your stock market and things like that. So again, very familiar process. People have been very educated about this for the last 15, 20 years, and it's become a very popular thing to do. And the associated limitations are quite familiar as well. Down on the bottom here, we have a rollover on business startup, or a RoBS transaction that we've been talking about. Same $100,000. It's rolled over into your new 401k account. The subsequent transaction of the stock purchasing happens. Now you have $100,000 in your corporation or your business that you can now go and use for business expenses. Well, it just so happens that this business is a real estate investment firm. And so you can go out and you can leverage that $100,000 and put in your 25% down into multiple assets, in this case 4, just keeping it real simple. And now what you have done, each of these assets are still generating $800 in gross rents per month. And so over here in our calculations, we have accounted for the debt coverage of $400 per month. And so we're actually netting $400 per month on each property. And that comes into $1,600 per month net, equals $19,200 per year net. That's a 19.2% return on our cash that we've put in. So all this money is now in your business that you can now use for business purposes. So it doesn't have to go back into the 401k account like the self-directed IRA. You can now use these funds in the business just like any other business would. Go out and buy more property. Go out and rehab a property, whatever it is that you want to do for that business. So what have you done? You've bought 4 assets instead of 1. You have increased your rate of return. You have increased your potential appreciation growth by a factor of 4, because now you have 4 single assets growing in a market if the market is growing. And then you also have 4 assets of depreciation that you can claim. So as you can see, there's multiple reasons why a rollover on business startup transaction is a very good option from a rate of return perspective. Now you're still going to have some business taxes and things that you need to be aware of that will diminish these returns just a little bit. Nothing that you're unfamiliar with. So for a business, for example, a lot of people say, can't I just use my self-directed IRA to fund in part or in whole my business? Say you're an ice cream shop. Well, generally speaking, an asset or investment is prohibited if you will in any way manage the operations of the investment. So if you're going to be putting this money into an ice cream shop or a franchise, burger joint or whatever, if it's through a self-directed method, you cannot be personally involved in it. So that way you can I guess it's pretty self-explanatory. You can't participate in the business. So if you invest in such an entity, which would certainly include your own business, or use the account as collateral for a loan of any type, the IRS will consider that the funds in this plan have been distributed. So at that point, you would incur your taxes and penalties and all kinds of stuff. On the flip side, on the bottom, when you use the RoBS Rollover on Business Startup transaction, you incur tax write-offs because you're using it for business expenses. You're building up your tax-deferred retirement account if you so choose. Remember, we can put away up to $56.4 thousand per year. And now this money, again, you can use it for anything you need to. Money down for a loan, payroll, marketing budget, supplies, inventory, rent or lease expenses on equipment or real estate if you want to operate inside of a real estate that you don't own. Use for any other business expense. So, frequently asked questions. Why a C corporation? A retirement plan designated by the IRS can purchase stock in a business as long as that business is a separately taxed entity. So not an LLC that you're taxed on, not an LP or S Corp. It needs to be a C corporation. So the C corporation is the only entity that is taxed by itself as an individual, hence that is what we need to use. Why should I consult with my CPA prior to starting this process? Well, your tax advisor and your bookkeeper and those types of folks who work with the details, the financial details and reporting of your business need to know what this process is and how it works. And so we like to have them from the beginning understanding how it works so that they can have the balance sheet correct and the ongoing administrative responsibilities are met. We recommend that you meet with your tax advisor in conjunction with one of our consultants. So that is what this next question is going to be is, hey, my financial consultant or CPA isn't quite familiar with this. Is this even legal, and how long have people been doing it? The governing body of law that allows the 401k plan to purchase stock in the plan sponsor was passed way back in 1974 when these types of plans were actually born. So from the very beginning, this has been a established and accepted use of funds. So no worries there. So it's just usually been done, as I have here, on large or big corporations in the public space. And what we're doing is we're just doing it on a small corporation in a private space. So that's relatively new as people are learning about it and implementing it. It's definitely gaining a lot of traction and ground with businesses. And for that reason, your CPA or attorney, financial advisor may not be aware of it. Can I take a paycheck? Absolutely, you can pay yourself a salary as soon as you have those funds in your business bank account, which is typically 4 to 5 weeks. Clear Capital Group and its partners suggest that you consult with your tax advisor and a payroll company about doing exactly that. You don't have to, but if you're going to be operating your business as an employee, you might as well pay yourself something. So that finishes up this presentation about RoBS, or Rollover on Business Transactions, or Business Startups. And I just wanted to say thank you for joining us. If you have any questions or you'd like to move forward on setting up a consultation with one of our partners who can do this for you, give me a call. Office number is 801-682-1722, or on my cell phone, 801-866-4136, or shoot me an email, joe@clearcapitalgroup.com. And with that, we'll talk to you soon. Bye-bye.